Pim's House, episode 8. I'm Jonathan Stern, and I'm here with Lewis Stevens. Dr. H was sadly unable to be with us. This is the show many of you have been waiting for. It's the financials episode. Lewis, I want to paint a complete picture of HIM's financial situation, historically, today, and then into the future. I know you prepared a presentation for us. Walk us through.
Sure. Thank you, Johnny. Thanks, everyone, for tuning in. I think the number one thing that I'll share as a preface to our discussion today is that regardless of how you feel about this business, it is the only telehealth company in the public markets operating at $1 billion in plus scale, specifically at a $1.4 billion, and generating robust free cash flow margins and doing so sustainably. There's been a lot of very vocal bears. There's been a lot of negativity surrounding the stock for years. You can go look at its share price. It fell 80, 85%, maybe more from 2021 to 2022. And after all of this pessimism, after all of this bearishness for the last 3 or 4 years, we're left with the financials that we're going to review today. And for the very most part, these financials are exceptional. Today, we're going to provide some North Star metrics for you to monitor over time, and we're going to address the bearish theses through the financials. Investing is an exercise in placing bets on companies, creating a diversified basket of interesting and compelling companies. And in my estimation and in the estimation of the greatest investors of all time, this is a quantitative endeavor. So we can discuss the qualitative nature of HIMSS. We can discuss the opinion of somebody that doesn't like the CEO. We can discuss the inklings or the feelings of people observing the company from a distance. But the reality of the company will be borne by the financials. Of course, to understand what the financials actually mean and to fully comprehensively understand them, we need to qualitatively assess the competitive advantages of the business and the nature of the business itself. But at the end of the day, the prudent way to invest is to build a basket of businesses that are quantitatively attractive, because so much of the qualitative elements of these businesses are difficult to discern. So that's the significance really of today's discussion. And so without further ado.
Okay, so front and center, slide 1 is this chart detailing HIM's subscriber growth over time. Lewis, take us through why this chart matters and what's going on here.
So the two things that I would point out are, number one, it's important to monitor the sequential growth here. We can see that in recent quarters, the sequential growth, that means from Q4 2023 to Q1 2024 to Q2 2024 sequentially, not year over year, growth has been quite healthy. We can also see that there's been some non-linearity in the growth. See, there's instances where growth slows. There's instances where growth accelerates. And that's the nature of business. And I think the bears in 2023 really honed in on the fact that growth had slowed sequentially. You can see it in the Q1, Q2, and Q3 2023, there was some sequential slowing. And the bears got very vocal about that. There was the Spruce Short report on the heels of that sequential slowing. And the stock declined for 6 months during that period.
We're talking about this area. I mean, I have to say it's a little difficult to tell with these bars, but this area right here, correct, Lewis?
Yes.
Can you see my mouse?
Yeah, no, you've that's it exactly. And I think we've discussed the idea that HIM's business model resembles Netflix to some degree, and the former CFO of Netflix, David Wells, is a board member of Hims and Hers Health. You look at Netflix's big declines. If I'm not mistaken, the 2011 85% catastrophic panic decline, the stock fell in 2011. 2012 thereabouts, you can see on the chart, it just had a monumental decline. That was related to a period where subscriber growth slowed and customer acquisition cost relative to new sub increased pretty dramatically. That ratio of CAC to new sub. For Netflix, there was some non-linearity in subscriber growth. And then the same thing happened in early 2022. The legendary investor, Bill Ackman, took a position in Netflix, and then a month later it reported earnings, and it turned out that subscribers had either flatlined, or I think it might have actually been a sequential decline. And that, along with higher rates, resulted in this great panic. And for investors in HIMS, you should 100% expect similar dynamics with the stock. In portions of 2023, we witnessed those dynamics, and we're going to touch on them further. But it's just the nature of business. There's non-linearity.
And so as we're sitting here on, it's October 8th right now, we're at what, 1.9 million subscribers with estimates of, I think, more than 2 million subscribers for Q3 2024. The final thing I want you to touch on, Lewis, is this expansion of the green or teal part of the bar, the personalized chunk of the bar. Tell us about that.
Yes, that was the second thing. I said it was going to be very short and concise. I ended up talking about a lot of contextualizing stuff. So thank you for getting me back on track, Johnny. But the personalized bar is very important. This represents HIM's most differentiated products, especially in the realm of weight loss. These will, in my estimation, they will virtually all be personalized. In the realm of, for instance, hair loss, I've mentioned it often, right? There's going to be these finasteride minoxidil combination medications with vitamin C and biotin. And these personalized medications are differentiated relative to the very basic generics that are out there. And HIMS has shared that these lead ultimately to greater retention. And retention is a crucial element of the thesis, as we will discuss throughout today's presentation.
And so we're not at half of total subscribers being personalized, but we're getting mighty close. And we're certainly up over, a year, 2-year basis as a percentage of total subscribers.
Yes, and this is very important for retention. I'll say, Johnny, Dr. H should have been here. And I knew he should have been here because he could have added well right there. Anyway.
I know, we're missing Dr. H. He'll be with us for episode 9. Lewis, final thing on the subscriber growth chart. This big 164% number, what is that referring to?
So that number is referring to the growth of personalized medication subscribers. So that's very heartening to see because it represents subscribers that are less likely to churn, and therefore there's greater retention, and therefore there's greater value per subscriber.
Okay, so next slide is revenue per subscriber. Walk us through this, Lewis.
So revenue per subscriber represents the cash value of each subscriber. And in the case of HIMS, there's $57 monthly. I'm reading from the slide to work through this with you. There's a $57 monthly online revenue average per subscriber. And so that's how much each subscriber is worth in terms of sales to HIMS on a monthly basis. But importantly, HIMS has an 80% gross margin. So you have to multiply that number by 80%. And that leaves you with the gross profit. That leaves you with a more definitive value for each subscriber. And now this metric is important because it can be annualized in such a way that we have a full year picture of what each subscriber is worth.
Lewis, would we expect this to be flat over a 2-year time horizon? I imagine we wouldn't want it to fall, but would we want to see some growth in the revenue per subscriber figure?
If I remember correctly, from all the data I've seen, the average revenue per subscriber has grown since 2020. Of course.
Since 2020, okay.
Yes. Of course, we expanded the money supply by 40%. So everybody's average revenue per subscriber should have grown by 40% in some respect. But, that could be debated, right? If HIMS had absolutely no pricing power and it was the most perfect commodity ever, even though we expanded the money supply by 40% and the price of everything went up by 40% as a result, maybe HIMS average revenue per subscriber degraded and was just flat for 4 years as a result of having no pricing power whatsoever. But it has increased, if I remember correctly from the data I've seen since 2020. As it relates to the last 2 years, HIMS has been working to, number one, personalize its offering to create unique formulations of the drugs that it offers. And it has also been working to extend the length of each subscription. So there are longer subscriptions that on a monthly basis are worth less, but there are more guaranteed cash flows associated with each customer due to the increased length of their subscriptions, which is a factor in retention. And now we've mentioned retention a couple times, and we're going to really delve into the importance of retention here shortly in this presentation.
This chart, not as nice looking from a design perspective. What's going on here?
So we can see total number of subscribers has grown by 43%. The average order value has grown by 27%. And the average order value is attributable to the longer duration subscriptions. And we can see that the monthly online revenue per subscriber remained relatively flat, while average order value has increased. And that is the result of these longer duration subscriptions where HIMSS is ultimately offering a discount for people to subscribe for longer periods of time. And I would probably contend that HIMSS is making the shorter duration subscriptions almost prohibitively expensive to push people fairly aggressively to these longer duration subscriptions so that they can lock in those durable cash flows, and the unit economics associated with the business are actually healthier and more robust as a result of the cash flows associated with each subscriber being longer and more guaranteed.
Okay, I think we're moving to the North Star here. What defines the health of Hims and Hers Health? Lewis, you're always talking about the difference between gross profit and sales and marketing as a percent of revenue. I've seen you write about this and heard you talk about it. What does that mean?
So I would argue, the HIMSS house is valuable for a number of reasons, but I would argue that it's very valuable because we have an expert in Dr. H on call at all times. He's contributing to our Discord communities, and he's on this podcast, and he's in the industry. He's boots on the ground, experiencing the industry, and he can provide his expert, differentiated opinion. In my case, I believe that I bring a differentiated view to the financials, to a financial analysis of Hims and Hers Health. I've been in the weeds of this discussion really since HIMSS went public, but it became a real focal point around early to mid 2023. And then ultimately we reached a peak when the Spruce Point Capital short report was released, a peak for controversy over the health of Hims and Hers unit economics. And ultimately, my perspective as it relates to all of this is that, yes, it is important to monitor customer acquisition costs per new subscriber. And mathematically, that is the amount of money Hims and Hers spends on sales and marketing in a quarter divided by the number of customers it's able to acquire via that spend. And it results in, as you can see on the slide here, where there's that little red, you can see the, Johnny's going over it now. There's it starts on the very left with 319, and on the very right, it's 842, and that's highlighted in red. And this is very important to monitor, but I do not believe it's the North Star of the thesis. And shorts and other investors have made it the North Star of the thesis. And I have contended since it became the North Star for so many people that it's ultimately a fallacious way to look at the thesis. And what's really important,
Just to slow you down a bit, Lewis, this is the customer acquisition cost. Is that right? So the cost to acquire a single customer?
Yes.
Got it.
And that's in dollars.
This isn't thousands of dollars. This is $842 Hims must spend for every customer it acquires. Is that right?
Yes. So the math, for instance, the dark red one, the scary dark red one, which is nearly 1,100, that math is $107 million divided by 93,000 customers. That equates to the 1,100 there. What's going on?
107 million, is that the marketing spend?
Yes, in the quarter. And then the 93,000 would be the total customers acquired.
Got it. Okay.
And so my contention through all of this has been, ultimately this should not be seen as the North Star. The North Star of the health of the business should be the difference between gross profit and sales and marketing nominally and as a percentage of revenue. And in these subsequent slides, we can see that HIM's marketing as a percentage of sales has never been lower. And meanwhile, its gross profit margins are nearly at their highest ever. And in the case of Q2 2024, they dipped a little bit because HEMS made some investments in building out its GLP-1 business, which compressed its gross margins a little bit. And to be sure, management has guided for between 70 and 80% gross margins over the long run. So there will be further compression here. But as of today, contrary to what the bears have been saying, and Johnny, if you could go back to the previous slide just real fast. Contrary to what the bears have been saying since the red started to appear in that chart below, at $920 per subscriber, that's Q1 2023. So there was great alarm over the cost of each subscriber in Q1 of 2023. That was nearly 2 years ago. But curiously, the sales and marketing as a percentage of revenue has never been lower. And the difference between gross profit and sales and marketing has never been higher. And as a result, free cash flow margins have never been higher. Free cash flow per share has never been higher. And the share price has ultimately never been higher. So we're at nearly 2 years of allegedly the unit economics being in the danger zone. And, we see the danger zone in red in the previous slide. But nearly 2 years later, the business is the healthiest it's ever been. So how could that be? And the answer is simply that the bears are not accounting for the unknown element of the thesis, which is churn. And you can play with this math yourself as a listener and viewer of this podcast. But you can run scenarios where if him spent $1,000 per subscriber and subsequently generated $65 a month for that subscriber, let's say $45 gross profit, and did so for 3 years with 100% retention, and let's take it even further for 5 years, obviously the unit economics would be very positive. Obviously, it would make sense to spend that money. And HIMS says that its payback period is less than 1 year on all of its marketing spend.
Its payback period on the CAC, is that correct, Lewis?
Yes.
So on the 842, the payback period is less than 1 year, meaning the value of that customer exceeds $842 in the first year. Is that correct? What must be true in order for the unit economics to make sense for HIMS in light of it costing $842 in the most recent quarter to acquire each new customer?
So this is the crux of all controversy with HIMS presently. It's indisputable that its free cash flow per share has been rising. It's indisputable that its free cash flow margins have been increasing. But there has been this increase in CAC per new subscriber recently. And if you just annualize the gross profit generated by each new subscriber over the course of a year, you will find that the payback period is longer than a year based on $1,000 outlay and $50 of gross profit per subscriber annualized. That being said, if you look at two pieces of data, number one, HIM's characterization of its payback period in its Q4 2023 investor presentation, you will find material, and unfortunately we didn't include it here, but you will find material illustrating HIM's customer acquisition cost outlay and subsequent cash flows generated from that outlay, which represents its year and multi-year payback period. The very simplified way that I prefer to look at all of this, principally because we do not know churn data. We don't know what percentage of its late 2017 cohorts churned. We don't know what percentage of its 2019 cohort has churned. And so the principal way that I like to look at it is, what is the payback period from a year's worth of CAC through the lens of its gross profit generation? And as this chart that we're looking at now demonstrates, HIMS has spent $517 million in sales and marketing over the last year, and it has generated nearly $900 million in gross profit over the last year. And the difference between these metrics, despite the scary red data in the previous slide, the difference between these metrics has increased for the last 2 years. And I believe that this is attributable to the fact that there are very durable books of business being layered on year after year with subscribers, for instance, that subscribe to finasteride and minoxidil, which is one that I use often, but that is a for life product.
Lewis, payback period is longer than 1 year at the moment. Is that right?
According to the CAC that you see there, $1,000, from which $45 of monthly average gross profit annualized over 12 months is generated, the payback period through that lens is greater than 1 year.
And to get there, you're multiplying the 61.6 times 12. Is that right?
80% of the 61.6 to arrive at gross profit, and then multiply that by 12.
Got it. So we're looking at $600 or so of gross profit
for a year.
Annualized.
Yes. And so that is what the bears have been citing. That is less than a year, which is contrary to what HIMSS has stated, which is the idea that it continues to have a less than 1 year payback period on that red bar, the metrics populating that red bar you see in the chart.
And so it must be the case then that the customers that signed up back here, some of them, many of them, maybe most of them, are still with the company. Is that the right way to think about it, Lewis?
Yes, because ultimately, coming back to our original discussion, what is a business? A business is a cash flow producing mechanism. And the value of the business will be the cash flows that it can produce for its shareholders and for its owners. And so ultimately, if a business is not generating cash flows, it's not going to be worth anything, right? Ultimately, if the unit economics are truly impaired, it won't be able to generate cash flows. But if there are cash flows from previous cohorts of subscribers continually being paid, then the net present value of the business will be positive, and there will be free cash flow generation. And we can see this most vividly, we can see this most clearly in the difference between gross profit and sales and marketing. It is the most perfect representation of the health of the business. In the absence of granular churn data for each year worth of each cohort, each year worth of members, in the absence of that churn data, we're left with what is the gross profit relative to marketing spend. And the difference between that metric is ultimately the clearest representation of the health of the business.
Now we have a few more slides. Take us through the universe of expenses beyond sales and marketing.
So we included this slide just to illustrate the idea that there is operating leverage in the business as revenue and gross profit have continued to grow at elevated rates, which the previous slide depicted. Gross profit has grown much faster than sales and marketing. As revenue and gross profit have grown, operating expenses as a percentage of revenue have continued to compress, thereby illustrating the inherent operating leverage in the business. And how is HIMSS generating this operating leverage while its cost per subscriber is increasing? And I think the number one answer is simply the idea that its previous cohorts are sticking around. The retention is stronger than the market has perceived, and the cash flows are building and compounding on each other. And that is resulting in this growing difference between gross profit and sales and marketing, ultimately with sales and marketing being a representation of operating expenses. And I think another idea that's worth noting is the idea that HIMSS is building brand equity, right? That should show up in declining cost per new subscriber, but over time, I believe brand equity will be an important element of growing gross profits in excess of sales and marketing.
Lewis, zooming out, trying to think about this holistically, I think the company just took out a full page in the New York Times. I don't know if it was a Sunday edition. You see them all over Twitter and Instagram and Facebook. There's been a significant marketing push. I guess we'll see in Q3 what the numbers actually are, but it feels like the company is pretty much full throttle with advertising and marketing. Given that, is the right conclusion to draw that they are comfortable with the customer acquisition cost so long as the marketing push is full throttle? They think they will be able to pay back whatever the expenses are?
At the end of the day, the North Star metric that I continue to highlight is simply the difference between gross profit and sales and marketing, because ultimately that feeds into free cash flow. Ultimately, that is the difference between those metrics is the mechanism by which free cash flow can be generated. And ultimately, what's the value of a business? It is the net present value of the cash flows that it produces. Every business is intended to be a cash flow producing mechanism, and that's the value of the business. And so that difference has grown in tandem with free cash flow. Now, to be less quantitative, and I would, before I continue, I would invite listeners to rebut what I'm saying. I would love to debate you in the comments, and I would love to continue the discussion with anybody that would like to have it, because it is contentious and it is central to the thesis in so many ways. You will find at the end of the day that the discussion is very difficult to have without granular churn data dating back to 2017, and we don't have that data. So ultimately, we're left with, number one, the chart that was shared in Q4 2023 investor presentation detailing HIM's payback period, alongside HIM's claims that the payback period remains under a year. And number two, the difference between gross profit and sales and marketing, which indisputably has continued to expand, downstream of which has been the growth of its free cash flow margin and the ascension of its free cash flow per share.
Lewis, could we back up real quick? The payback period, HIMS is saying the payback period is less than 1 year?
Yes.
Despite what we've seen in the...
That's controversial.
ARPU to CAC comparison, is that correct?
Yes, it's controversial.
Okay. All right. Well,
it's controversial. It would be nice to have a CFO Yamir Coupe on.
All right. It'd be good to get some color on that then. I mean, I think that's a thorough discussion of the situation. I don't know that there's much more to say other than it is sort of hard to make a perfect determination in the absence of churn data. But the jaws widening on this chart is certainly a positive indicator.
And then if we go to the next couple slides, we can see on this slide that, I mentioned downstream of the difference between gross profit and sales and marketing, profit margins have been expanding. It is that difference that allows profit margins to expand. It is the idea that cohorts of subscribers from previous years are sticking around and producing cash flows and just continuing to produce those cash flows. And HIMS is layering on new cohorts that stick around and continue to produce cash flows. And ultimately, those cash flows begin to flow to the bottom line as the business reaches certain scale. And we can see this in the net income and the EBITDA data that HIMS has provided. And importantly, what I would highlight is, according to the bears, and admittedly, the CAC per new subscriber has increased. But according to the bears, and specifically Spruce Point Capital, the unit economics have been impaired for, going on 2 years now. And we can see very clearly here that not only has gross profit relative to sales and marketing reached an all-time high, but also profit margins have reached an all-time high. So might there be degradation in the unit economics as measured by gross profit and sales and marketing and free cash flow margin and net income and EBITDA margin? Possibly. But now we're quite far removed from the onset of this elevated CAC that should cause total panic and is contrary to what HIM's management continues to claim, which is that the unit economics remain healthy. So now we're far removed from the onset of the panic, and the business is doing better than ever. And so again, it comes back to the idea that the onset of the panic was a bit premature because we don't know granular churn data. And you can run the various different scenarios as it relates to churn. You can do the math. If 80% of a cohort sticks around for 5 years at a certain amount of gross profit, that will be very different than if 25% of the cohort stuck around. And we don't know exactly how much of each cohort is sticking around. We just don't have that data. And perhaps the argument, and certainly the argument could be made, that HIMS needs to be more transparent with the data, but there's...
Lewis, what is the best argument for why they're not releasing the churn data? If I'm coming at this objectively, and we've established that churn matters for valuing the business and being able to value the business presently, but also into the future, If the company is not disclosing this critical metric, my mind instantly goes to the idea that it might not look as good as they want. Is that a reasonable assumption or not, given the situation with gross profit and sales and marketing?
Yeah, I mean, I think it looks horrible. I think it looks terrible.
Churn?
Yeah, I think churn looks terrible. And I think it does because churn for an urgent care or primary care against whom HIMSS competes is going to be terrible.
Right.
It's going to be vicious. I mean, it's probably going to be 25 to 50%.
Which is why in recent episodes, we discussed the fact that each part of the business needs to be considered on its own. Each product has its own churn dynamic.
Yes, 100%. I mean, and that's another element of it. It's like it's like Wall Street wants to compare HIMSS to CrowdStrike, where it's indispensable security products with 24-month payback periods, right? The payback periods for software are pretty bad. It takes oftentimes years for the gross profit to pay back the sales and marketing, the CAC per new customer. But the retention is 95 to 99%. So in the net present value calculation, you spend $100, you get 50 back in the first year, you get another 50 back in the second year. So it's, a two-year payback period, but then you have $50 in perpetuity, like an annuity for the next 10 years. So after that 2-year payback period, you layer on $500 of just free money. There's a cost of goods sold, but relatively speaking, it's very cheap. And then you can upsell them on new products.
Right.
And that's ongoing within the HIMSS business, but it's not that business model. It just isn't. That's not how medicine works. That is the case for finasteride and minoxidil, and that is an attractive element of the HIMSS business model. But for the majority of its products, the products are interventions that treat something that's acute in nature that may last 6 months, a year, and then the patient, doesn't necessarily need them. That's the nature of medicine. I've forgotten your question, but it's worth noting those business model differences.
Well, first I asked about what do we think churn looks like? Your answer was probably not so good. And then I said, well, probably not so good because each product needs to be considered on its own. And we would expect, given that HIMSS is in medicine and many of their products are not the sort that you would expect SaaS-like subscription revenue for, that there will be churn.
Yes, and there's certainly churn in this business model. And that's why I just continue to highlight, I think it's a unique business model, but I continue to highlight that the North Star is gross profit, sales, and marketing. And I've been saying this since the Spruce short report came out. My main rebuttal has been, and this rebuttal was made before the difference between sales and marketing and gross profit really started to expand. My argument was, after reviewing what they said, considering it deeply, really thinking about it, my conclusion and argument was, we don't know churn. So if we don't know churn, then we're totally speculating on what this means, on what this math means.
And Lewis, to be very clear, the reason this is the North Star is that it's the surest predictor for what free cash flow generation is going to look like over time.
Yes. And it is a representation of the health of the business. It is a representation of how many patients, subscribers have been retained over the last 6 years. It's a representation of retention in some respect, which you just don't get looking at the quarterly data. I'll say, I would prefer the CAC per new subscriber to not be increasing. It would be nice if it hadn't doubled over the last 3 or 4 years. If it just remained static at 100, that obviously, I'm not going to say it's not.
We might have a $50 or $100 stock if that were the case.
Oh yeah, the stock would be much higher. But it's also not the death knell of the business as it's been painted to be for going on years now. And now we're at this period where the business is the best it's ever been quantitatively.
Okay, Lewis, so wrap us up here. We have free cash flow as a percent of quarterly revenues at 15% today. We have the jaws widening on this chart, gross profit relative to sales and marketing as a percent of revenue. We have CAC that is admittedly a little higher than we want, at least relative to ARPU. What are the conclusions that you draw from all of this? How should we think about hims and hers? Paint the full portrait. Take us home.
Sure, Johnny. So the number one thing I would say is continue to pay attention to gross profit and sales and marketing. If that continues to widen, then free cash flow margins will continue to widen and free cash flow per share will continue to increase. And ultimately, the basis of all stock value is free cash flow per share, right? We've spent a bit of time on this podcast discussing the idea that the value of a stock is the cash that it will produce. So naturally, the number one metric for the business is free cash flow per share. And so I concluded here with the 4 points of equity value. So at the end of the day, what matters? You buy a stock to generate cash, right? At the end of the day, the cash that the business provides is what matters. And in addition to just the cash, there's a couple more important factors to consider. So you have the cash that it generates, the growth of that cash over time, and the durability of that cash and what you can get elsewhere, right? How durable do I think that is? During a recession, how much does it decline? Is it going to be something like a bond? Is it going to be something like Washington Mutual's mortgage loan book in 2008? If it's the latter, then we're going to have to demand a very high return here, right?
Right.
But if it's closer to the risk-free rate, the valuation that we assign by year 10 is going to be, pretty different. So that is the fundamental basis of the value of any stock. And it's so simple. You don't need anything else. That's all. That's the extent of it. If you can answer all of the variables that I just described for any stock, you have the value of that business. You can tune out everything else. You can build a basket of businesses where you can have that discussion for each one, and you can create a really compelling portfolio. And HIMS, I think, is a great business to consider within a basket of stocks, and that's where I'll leave it.
This has been fantastic. I learned a ton. Thank you, Lewis, for allowing me to push back and challenge at various points. This is certainly not the end of this discussion. There's a lot more to unpack and discuss in the future. Of course, HIMS reports in early November, and we'll be discussing the earnings report at length when that happens. So thank you so much. This has been HIMS House, episode 8. We will see you next time.